Does CCFS 2026 itself provide for automatic strike off of defaulting companies? This is a question. The answer is no. See, the government has specifically clarified that the CCFS 2026 does not envisage strike off of companies under Section 248 subsection 1. So the expiry of CCFS 2026 window should not be interpreted to mean that every company which has not availed the scheme will automatically be strike off. That is not correct. This should not be misunderstood as providing immunity from the independent statutory power available to the ROC under the Companies Act 2013. Can the registrar still initiate strike-off proceedings under Section 248? Answer is yes. Section 248 of Companies Act 2013 continues to operate independently. For example, the registrar may exercise the statutory power where the conditions prescribed under Section 248 subsection 1 are satisfied, including circumstances where a company has not carried on any business or operations for 2 immediately preceding financial years and has not made an application for dormant status under Section 455 of Companies Act 2013. So the statutory process also requires the prescribed notice and opportunity for our representation before the removal of a company's name. So CCFS does not envisage strike off should not be read as Section 248 strike off cannot happen. That is a different, this is a different. So the distinction is this is a critical from a professional compliance perspective. Is CCFS compulsory for company having pending filings? Answer is no. CCFS is a facilitation mechanism and its availability should not be confused with a permanent relaxation of the underlying statutory filing obligation. Where a company has pending filings, the board and the management should independently evaluate the nature and period of the defaults, where the company is operational or inactive, whether the statutory liabilities are outstanding, whether the company intends to continue business, or whether the dormant status is appropriate, and whether the closure through Section 248 subsection 2 is commercially and legally appropriate. So these things management has to check, board has to decide. If a company is inactive, should it immediately apply for strike off? Answer is not necessary. An inactive company should first determine whether it is genuinely defunct or merely temporary inactive. If the company is expected to resume business, if the company is resume its business in future, so dormant status under Section 455 may be an appropriate option. So a company can apply for dormant status. If the company has permanently ceased operations, has no continuing business purpose, and can satisfy the statutory conditions, voluntary strike off under Section 248 subsection 2 may be considered. So the decision should therefore be based on the future corporate requirement of the company rather than merely on the existence of the filing defaults. Based on the future requirement, does an inactive company automatically become eligible for strike off? No. Inactive alone is not sufficient. A company proposing voluntary removal of its name must satisfy the applicable requirements under Section 248 of the Companies Act and companies removal of the names of companies from the Register of Companies Rules 2016. So the company must also examine its liabilities, assets, pending proceedings, charges, statutory dues, and other matters before proceeding. So accordingly, PCS should undertake a pre-strike of due diligence rather than treating STK2 filing as a routine form filing. So is clearing a very historical filing always necessary before voluntary strike off? Any pending filings are there? Is it required to file first and then go for strike off? The answer is the position needs to be examined with reference to Rule 4 of companies removal of names of the companies from the Register of Companies Rules 2016. Particularly, so if you see the period up to which the financial statements and annual returns are required to be filed, that has to be first checked. The practical approach should be to identify the financial year in which the company ceased its business operations and determine the filing obligations up to the relevant strike-off or relevant statutory cutoff. This obligation. The practical approach. First, identify the financial year in which the company ceased its operations, its business, and determine the filing obligation up to the relevant statutory cutoff. Because section clearly speaks this, where the registrar has already initiated an action under Section 248 subsection 1, the position requires additional examination because the consequences and the filing requirements may differ depending upon the stage of the proceedings. So the blanket statement that all historical filings must always be completed is not an appropriate professional conclusion. It depends on the situation. Can a company use CCFS 2026 to regularize its records and subsequently apply for strike-off? Yes, subject to the statutory conditions and the eligible provisions of the scheme. Yes, this can be a sensible compliance strategy for an inactive company where historical filings are pending and the company proposes to close its affairs. However, the sequence should be carefully planned. A professional may broadly examine the sequence like identify defaults, determine eligibility under CCFS, regularize applicable filings, then settle liabilities, then complete closure related compliance, consider STK2. So the precise sequence should depend on the company's circumstances and the applicable provisions. Does CCFS 2026 prevent the registrar from exercising Section 248 powers after the scheme period? The answer is no. The government's clarification is that CCFS 2026 itself does not envisage strike-off. This does not extinguish or suspend the statutory powers of the registrar under Section 248. Therefore, the company should not adopt a wait and watch approach merely because the scheme does not provide for automatic strike-off. Then what would the companies with several years of non-compliance due before 31st August 2026. Such companies should undertake an immediate compliance status review. The review should preferably cover pending AOC4 and applicable variants, pending MGT7 or MGT7A, auditor-related filings, change in directors and KMPs, registered office compliances, charges and satisfaction of charges, statutory registers and minutes, financial statements and audit status, income tax and GST position, wherever relevant, bank account status, outstanding creditors and debtors, litigation and regulatory proceedings, and the company's future business intention. So the objective should merely be to file the forms before the deadline. The objective should be to restore the company's statutory and corporate records to a defensible position. What is the significance of the government's latest clarification for PCS professionals? See, there is a clarification which reinforces an important principle: compliance regularization and corporate closure are two separate legal exercises. So a PCS advising an inactive company should therefore not automatically recommend either CCFS filing or strike off. So the professional assessment should consider the compliance status, operational status, liabilities, litigation, corporate purpose, and future requirement. Only after this assessment should the appropriate route be recommended. Does the expression shell company have a specific statutory definition under the Companies Act? See, the government has clarified that the expression shell company is not defined under Companies Act 2013. Professionals should exercise caution before describing an inactive or non-compliant company as a shell company. Non-operation, filing default, and absence of substantial business may be relevant fact, but these should not be automatically be equated with the statutory classification that does not exist under Companies Act. So what is the practical difference between dormant status and strike off? Dormant status means it is a generally appropriate where the company is not actively carrying on business, but the corporate entity is intended to be retained. The company continues to exist as a legal entity, subject to the applicable provisions of Section 455. What is strike off? It is appropriate where the company has ceased operations and there is no continuing requirement to retain the corporate entity, subject to fulfillment of the statutory conditions. So once the name is removed and the company is dissolved, the legal consequences are materially different. Dormancy is not a substitute for strike off, and strike off should not be treated as a temporary dormant mechanism. So what should the board consider before deciding to close an inactive company? So the board should ideally consider a structured checklist covering whether the company has genuinely ceased business, where any assets remain, where any liabilities remain, where creditors have been settled, or where any statutory dues are pending, or whether any litigation or investigation is pending, or where the charges remain outstanding, where the bank account have been appropriately dealt with, whether there are employees related obligations, whether any tax or regulatory proceedings are pending, and whether the company may required or future business or restructuring. So the board decision should be supported by appropriate records and documentation. So what should be the professional approach in such cases? A PCS should preferably avoid treating CCFS 2026 as a merely discounted filing opportunity. The more appropriate approach is to conduct a 3-stage assessment. The first one is compliance diagnosis. So identify all statutory defaults and determine which of them can be regularized under the scheme. Second one, corporate status assessment. Determine whether the company is operational, temporarily inactive, dormant in substance, defunct, or required for future corporate purpose. Then strategic recommendation. Based on the findings, advise the board on whether to continue business, regularize and remain active, apply for a dormant status, apply for voluntary strike-off. So the approach provides significantly a greater professional value than simply processing overdue forms. So here the takeaway is the government clarification on CCFS 2026 should be understood carefully. CCFS is a compliance facilitation mechanism, not a strike-off mechanism. Section 248 continues to provide the statutory framework for removal the name from the register of companies. At the same time, the CCFS window provides eligible companies an opportunity to address the specified historical compliance defaults on the terms provided under the scheme. For the boards and professionals, the immediate question should therefore not be will the company be strike off after CCFS 2026. So the better question is what is the appropriate legal and corporate status of this company and what action should be taken before the compliance window closes. Thank you.